I've found 7 dividend-paying stocks that produce an average 9.6% cash flow and are up 12% over the past year. Hey Bowtie Nation, Joseph Hogue here, and the idea of passive income from dividend stocks has always kind of bugged me a little. And the income certainly isn't passive for the companies paying that dividend, and you had to work for that money to invest it anyway, so how passive can it really be? Well, now I found a group of stocks that is about as close as you're going to get to passive income investing. A group of stocks where the income is truly passive for investors and the companies, royalty income trusts. Now, these special types of dividend stocks pay some of the highest yields in the market and come with a tax break that makes them a must-watch. I want to get started on our list with Uranium Royalty Corporation, ticker UROY, but stick around because I'm going to detail the pros and cons of these royalty trusts. The push to green energy is only getting stronger, and despite all the news around electrification, nuclear power has the lowest carbon footprint of all the alternative energy sources and is already a source in production. There are already 426 reactors in operation worldwide, 64 of those just since 2013, and another 57 under construction. Demand for uranium, the fuel on which these reactors run, is expected to grow by 3% annually through 2040 and beyond, with about 20% of that demand in the United States. But the problem is, because uranium prices are too low to stimulate the new production, the supply growth just hasn't kept up. The gray bars here are the current production of uranium, with the blue line demand from existing reactors, and then potential demand growth in blue shaded area. The production gap last year alone was 56,000 pounds, and it's only been through storage that the world has been able to meet its demand. But that's not going to last forever, and uranium prices will move higher as that gap widens. A uranium royalty is the first to apply the royalty model to uranium assets, so as a partnership interest in those uranium projects receives the cash flow and then passes that through to investors through a dividend distribution. It's not yet making payments here, but several projects are close to production, so dividends could start very soon on this one. The company has a diversified portfolio across North America and in every stage of development, from permitted projects, production, and exploration. Its partners include some of the largest uranium miners in the market, like Cameco, Rio Tinto, and UEC. And here you can see how this is set up. For example, the company has a 9% interest and 1% gross overriding royalty in the McArthur River project run by Cameco there in Canada. The project is licensed to produce 25,000 pounds a year with proven and probable reserves of almost 392,000 pounds. The company has a strong balance sheet with $16 million in cash for further acquisitions. Uranium stocks shot up over the past 2 years, and it could happen again as the price of uranium rises, meaning a solid upside potential along with the dividend when these projects start producing. Now, I'm going to link to the company's investor presentation in the description below if you want to check this out. Cross Timbers Royalty Trust, ticker CRT, and its 11% dividend is what you see more often in these income investments. Cross Timbers is an energy trust formed in 1991 on oil assets in Texas, Oklahoma, and New Mexico. Now, the fields were originally operated by XTO Energy, but it was acquired by Exxon in 2009, so you've got one of the world's largest oil companies managing these assets. In its most recent quarter, CRT booked a 55% increase in net profit income to $3.8 million, and again, you look at these administration expenses here of just $86,000, less than $100,000 to run this company and distribute those profits to investors. You see, that is the power of this royalty trust structure, a pure pass-through of income without the bloated corporate payroll and taxes. Over the quarter, the trust paid out the distributable 62 cents per share in 3 monthly payments, so you're getting a monthly cash flow from a lot of these royalty trusts. Now, of course, that third quarter performance was on the back of oil prices that started at $97 a barrel before ending lower in September at $81 each. Now, that's just under the current $82 where we see oil trading right now, but this is the big risk with these energy trusts. Now, CRT reports an estimated lifespan of reserves just over 10 years, but that's been extended for years now over new technologies to get more out of those old oil fields, but it all comes down to the price of oil. A recession in the United States, but returning growth in China is likely to keep oil kind of range-bound from $70 to $80 a barrel for the next year. And that's still going to be a solid dividend on energy trusts, but it's also why I wanted to consider diversifying into some of these non-energy trusts as well. Now, we're just getting started on our list of royalty trust stocks, but what is a trust and Why are these some of the best sources you're going to find for that passive income? So royalty trusts are a special type of company set up to hold an income-producing asset and then pass all that income on to investors. Not only do these offer dividend yields well above the market average, but there are a lot of other benefits that make these even better than your traditional dividend stocks. And how these works is the companies usually buy those percentage rights to the assets like an oil field or gold or copper mine. The exploration company is going to get that one-time payment for the percentage share of the production. And the company then continues to manage that asset, so drilling for oil on those fields or mining for gold reserves. Royalty trusts then have no employees. It's just a financial account that receives that percentage share from the exploration company and then passes it on to investors. And so because the structure is so simple here, there's really no financial statements to analyze. There aren't going to be any of the accounting tricks that you find with other companies, using to make their revenue look bigger or their expenses smaller. It's just one income-producing asset and the distributions. So not only is it a simpler, more efficient investment than those traditional dividend-paying companies, but there's also a tax break to boot that I'm going to reveal later. Back to our list of passive income royalties though, and one I bought recently, Gold Royalty, ticker GROY. The company acquires royalty, stream rights, and other interests in mines at different stages in the mining cycle for a balanced portfolio. Right now with just over half of its assets in Canada and a third in the United States. Now you're going to notice through this list that I've tried to include royalty trusts from different commodities, so not just those traditional oil and gas trusts. This way, you're going to get a more diversified income stream tied to gold, oil, steel, and even uranium. The mining projects for Gold Royalty are managed by the best in the industry, like Newmont, Barrick Gold, and Agnico Eagle. Of the 200 plus royalty deals, Gold Royalty has 6 already producing revenue and 7 more that are going to start producing over the next 5 years. That alone is expected to grow revenue from $5 million this year to over $20 million through 2025, and a 4-fold increase in less than 3 years. But here, what really convinced me to buy the shares though was on the management team, specifically CEO David Garofalo. Before coming to Gold Royalty, he served as CEO of Goldcorp, once the world's largest gold miner, from 2016 until its acquisition by Newmont in 2019. Before that, he served Agnico Eagle for 12 years as a CFO, a period that saw an 18-fold increase in the stock price. So for me, that meant a lot of confidence in what management was saying and where the company could go in revenue. I bought 2,000 shares here for just under $2.17 each for a $4,300 investment. Next, the Mesa Royalty Trust, ticker MTR, and its current 11% dividend yield is one of the older energy trusts. Now, this trust was created in 1979 to own 11% of the 90% of net proceeds from the Hugoton field in Kansas, along with the San Juan Basin fields in New Mexico and Colorado. Now, the field here is currently operated by smaller players like Hillcore and Red Willow in comparison to a lot of the recognized oil producers that run some of the bigger trusts, which is why I think Mesa is relatively less followed by investors. But even on its age though, proved reserves have actually been increasing consistently for years on those advances in extraction. The trust closed last year with 14,000 barrels and 8 million cubic feet of natural gas. Now this one does have the most limited lifespan of the group, but because it's not followed by many investors, there is still an opportunity when oil spikes. The trust produced an 85% total return over the last year and will continue to churn out those dividends for years to come. We still got 3 more passive income trusts to highlight, including one that has produced an 83% total return in less than 2 years. But I want to look at the pros and cons of these trusts here and why these are good investments. The big upside to these trusts is just that higher dividend yield compared to other income stocks. For example, the Schwab Dividend ETF, ticker SCHD, one of my favorite dividend ETFs, is one of the stronger dividend funds but only pays a 3.6% yield. Even the Vanguard Real Estate Fund, ticker VNQ, which owns those income-producing REITs, only pays a 4% yield. With royalty trusts, you not only get a higher dividend, usually around 5% and higher, but most of that is not taxable. We're going to talk more about taxes on royalty trusts later, but these have a great hidden tax break where you only pay taxes on the investment after you sell it instead of yearly on those dividend payments. Another upside here is that because these trusts are a special type of company, they don't pay corporate income taxes on their income. It's just a much more efficient way to hold these assets compared to other companies like Exxon or Chevron. Royalty trusts are able to distribute nearly all their income instead of having to pay those operational costs and the income taxes. But as we say here on the channel, it ain't all rainbows and unicorns. There are some downsides to these royalty trusts that you need to know about if you're going to decide whether these are right for your portfolio. First, these are those limited life investments and may have those declining dividend payments in the latter years of the asset. Remember, royalty trusts are set up for buying those rights to an oil field or a mining deposit. After that initial setup, they don't buy any assets, so to speak, so once that production runs out, so do the payments. Of course, for most of these mining and oil assets, that could be 2 or 3 decades of production, so it's not something most investors even have to worry about. Also, because of those advancements in technology, a lot of times the production life of these gets even extended because they can pull out every last ounce out of those fields. When the production does get down to that point, though, the operator either buys back the shares or the trust manager just liquidates those assets and sends a check out to its shareholders. Now, another drawback of these royalty trusts is the payouts can be extremely volatile. You're getting a cut of those sales here, so everything depends on that commodity price and how much the asset is producing. It's great when commodity prices are rising because you get a higher payout, but it can also work the other way as well. Next is one of the most popular royalty trusts out there, Sabine Royalty, ticker SBR, an energy trust paying an 11.5% yield, where shares up more than 24% over the last year. The company has an oil and gas portfolio that covers over 2 million acres in Florida, Louisiana, Mississippi, New Mexico, Oklahoma, and Texas. Reserves on the assets are estimated to produce at least another 8 to 10 years, but again here, the reserve life has been extended several times in the past on just new drilling techniques as well as discoveries in the fields. And a lot of times that's a big overlooked upside to these trusts. They do have that limited shelf life because of the depleting assets, but improvements in extraction for these commodities will extend that life and can drive big swings in the stock price. Like all the oil royalty trusts, Sabine has benefited from that rise in energy prices over the last year. Not only did the company pay out a combined $8.65 in dividends last year, paid out in monthly distributions, but the stock has run higher for an 83% total return over the last 15 months. For more diversification here, I wanted to include the Masabi Trust, ticker MSB, with its 19.5% dividend and exposure to steel. Masabi is a steel royalty trust with an investment in mines operated by North Shore Mining, a subsidiary of Cleveland-Cliffs. Now, North Shore mines the ores, processes it into pellets, and sends it off to Cleveland-Cliffs, and then just pays Masabi royalties based on the selling price. So again, Masabi here has no operational duties or costs. It's just a trust that receives those royalties. Now, this is also one of the longer life trusts in the list with an estimated reserves of nearly 800 million tons and over 15 years left in production. Remember, these royalty trusts are not as consistent with that dividend amount as your regular dividend stocks. It's just going to jump around as they pass on all that profit to investors. But right now, with a yield nearly 20%, it is definitely one to watch. We still got one more royalty trust to highlight, but taxes are a big topic in these, and you need to understand how a little bit of pain can actually be one of your biggest points of gain. So we've already talked about how these are special types of companies that don't pay those corporate taxes as long as they pass on almost all of their income to investors as that distribution. And that means it's a great way to manage these assets much more efficiently than that regular corporate structure, and it means you get a strong dividend yield. But it also means you're going to get a different tax form for these each year. Your brokerage account where you hold these shares is going to send you what's called a 1099 form for each royalty trust that you own. It's going to show the distributions and how you report them on your taxes. And yes, I know this can be a pain figuring these out that first year, but it is actually pretty easy, and there's a huge benefit hidden here in the way these are taxed. Like MLPs, nearly all of your dividend from these royalty trusts are going to come to you as a return of capital. It's a return of the money you invested in the shares, not technically a dividend or a return on your money. And the beauty of this is that means you do not pay taxes on the money you receive. The dividend you collect from these is going to go to lower the price you paid on the shares. So here, say you paid $5 for each share, and over the 5 years, you collect $2 in dividends. That's going to mean when you eventually go to sell those shares, you take that adjusted cost basis of $3. That's $5 the original price minus the $2 in dividends you collected when you're figuring out that capital gains tax. And the benefit here is because with regular dividend stocks, you have to pay taxes on that amount you collect every single year. It's a major hit to the returns. So this ability to defer your taxes for years while you own these trusts, it's a great way to invest. One of the larger yields here with VOC Energy Trust, ticker VOC, and it's currently 14% dividend yield. VOC was formed in 2010, so a relatively newer trust here with 151 oil fields in Kansas and 4 in Texas. The table here shows the proved reserves with over 7.5 million barrels of oil and 5.2 million cubic feet of natural gas reserves. The trust also estimates a net profit interest remaining on those reserves, almost $100 million through December 2030, or when 10.6 million barrels of oil equivalent had been produced and the properties have been sold. Shares have produced a 38% total return over the last year, so not quite as strong as some of the other energy trusts, but probably has longer to produce on those assets that could mean higher long-term returns. Click on the video to the right for the 5 penny stocks I'm investing over $40,000 in right now. Penny stocks for 5 and 10x returns. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.